Pot stocks might be on fire recently, but our next guest says that one Canadian company's stock isn't going high enough. Investor Riposte Capital says that Hexo needs to explore strategic options, saying that if it doesn't, it won't be able to compete in the cannabis industry. Joining us right now is Khaled Beydoun of Riposte Capital, and it's great to see you. Thanks for coming in.
Thank you for having me on.
Let's talk a little bit about this. We've been talking about the cannabis stocks writ large, but specifically some that were really on fire yesterday. They all seem to be taking off, and people are saying this is just too much too soon. Why do you think Hexo is different? What's happening?
Well, what's ironic about Hexo is, and the reason why we decided to go activist or semi-activist, is because of the valuation gap. So when we wrote the letter about 2 weeks ago, Hexo was trading on 8 times EBITDA, and the sector average was on 30 times EBITDA. Mm-hmm. Today, Hexo is on 12 times EBITDA, but the sector's on 40 times. So actually, the gap has widened.
Why was the gap there to begin with?
A couple of reasons. One is there's no US listing. The other is they've done a pretty insufficient and poor effort at investor relations and marketing, whereas their peers have done an amazing PR effort. I mean, a lot of the stuff that you see today is very press release driven, and the fundamentals behind it are quite soft.
I would argue that that's definitely the case. We are seeing stocks double in value based on the idea that the CEO says, hey, we should be really looked at closely by the beverage industry. I'm not sure that's a good thing, though. Why do you think that Hexo should be part of that?
Whether it's good or bad is not really what we're looking at today. What we're saying is you have a company that's trading at half the multiple of the sector, and it's an industry that's going to need a lot of capital in the next 3 to 4 years. So if you need capital, you have to issue capital. It's at a huge disadvantage for investors today like ourselves. If Hexo issues capital at 12 times EBITDA, when competitors can issue capital at 40, 50, in the case of Tilray, over 200 times EBITDA. And so if they really do care about shareholders, and if they do work for shareholders, it's in their best interest to pursue a sale or a merger with one of their competitors, because that way you can monetize right away.
But have the stocks that you're benchmarking the valuation of Hexo to gone to such a height that a strategic investor would not buy them at that level? In other words, do they genuinely have capital available at those multiples, or is it just these stocks being traded wildly?
Even if you take out the two kind of insanely valued companies, Tilray and Canopy, the sector average is still around 27 times, and Hexo is at 12. So someone can afford to pay 100% premium for Hexo and still have it be accretive from year one. I mean, in my career, I've rarely seen that. The other thing, which is really important, is Hexo has about 400 million of cash sitting on its balance sheet today. So if someone buys Hexo, they get their hands on that cash. That might be way more powerful than trying to go out and raise equity like you just mentioned.
So what has to happen at the company? I mean, is this a management problem? I know you said it's not not having a U.S. listing.
I think in November we should get a U.S. listing, which should help a little bit. They need to be way more proactive with their marketing. They have to go.
What does that mean? Just the CEO being out there? Just
the CEO being out there. You know, you have to go and find Hexo. Hexo doesn't find you. If you look at these other companies like Kronos or Tilray or Canopy, you know, they're waving the flag every single day in the market. So we've given them 4 options. One is a merger, one is a potential sale, one is a private equity takeout, but they have to do something. They cannot stand alone today and not do anything.
How much do you own?
So we are the second largest shareholder in the company. We don't disclose our exact ownership, but it's the second largest.
Well, if it was more than 5, you would, so it's not 5%.
It's not 5%, no, but you need 5% to basically force a proxy or an AGM. But you know, we're pretty confident that other shareholders are thinking alike, because it's just mathematics. It's not more than that.
Longer term, is there anything proprietary in a lot of these businesses? Is it basically just a commodity business? Are there brands that are going to have value longer term?
It's a brand. It's not production. So who's able to build a brand? Hexo is the only company, apart from Canopy, that has a partner, which is Molson Coors. The other company, Canopy, has Constellation Brands. They're valued at 24 billion. Hexo's valued at 1.4 billion. So there's way too big of a gap there to explain.
Ken?
Yeah. It's only 10 or 15 years ago, there was a massive wave by state pension funds, for example, that you had to get out of any stock that was involved in tobacco, right? Right? When does this wave, because I'm thinking as a very long-term investor, when does this wave hit that people are going to wake up and say, hey, wait a minute, what's the difference in this business versus the tobacco business? Tell me the difference. And I think reason eventually does, over the long term, prevail. I can't participate in this discussion because I wouldn't own any of them. And in fact, if I had a wish, like I felt about the tobacco stocks, I wish they would all go broke when you go down to a hospital and you see somebody dying of lung cancer that you know was a 3-pack-a-day smoker. You know, there are significant drawbacks to society in this industry, which I think you would agree with.
I don't disagree with that. But we're just focused here on this particular company.
I know.
Well, it's not a stigma thing or saying it's a good thing.
No, it's a way to make money, okay? And that's your business. People invest with you for you to figure a way out to give them better returns than they would have gotten with somebody else.
To identify a situation like this, which we think is incredibly unique. I mean, I haven't seen this type of diverse valuation gap before.
Well, but as I say, take the business aspect out of it. It's numbers you're looking at, right?
Correct. That's exactly
okay.
It. Just numbers.
All I'm saying is, at what point does reason and history kick in to make us ask ourselves the question, what the hell are we doing?
Okay. Cal, I want to thank you for joining us today.
Thank you very much.
Cal Beydoun of Riposte.
Thank you.